It's Finance Week here, and this week is all about stripping away all the finance jargon. I am Felix.
And I am Ruby.
Today, we're diving into a term you've likely heard in financial news, especially during economic downturns: quantitative easing, or QE for short.
That's right. It sounds complex, but at its core, it's a special tool that central banks use to give the economy a significant boost.
Exactly. Think of it as an emergency measure. It's used when the usual methods, like cutting interest rates, just aren't enough to get things moving.
So, what happens when those standard tools are maxed out and the economy is still struggling?
That's where QE comes in. There's a great analogy that helps explain it. Imagine the economy is a wilting garden during a drought.
Okay, I'm following. The garden needs water to grow.
Precisely. In normal times, a little rain, which we can think of as regular interest rate cuts, is enough to keep the garden healthy. But during a severe drought, that rain isn't enough.
So, the garden is still wilting. What does the central bank do then?
The central bank brings out a giant hose and floods the garden with water. That hose is quantitative easing. It's a way to push a large amount of money into the system to get things growing again.
That makes sense. It's a much more powerful intervention. So, what is the ultimate goal of flooding the system with money?
The main objective is to lower borrowing costs across the board. When it's cheaper to borrow money, the hope is that it will encourage more lending, more spending, and more investment throughout the economy.
That makes sense as a goal. So, let's get into the mechanics. How does the central bank actually go about injecting that money into the system?
It's a fascinating process, and it starts with the creation of new money. Crucially, this money is created electronically. We're not talking about running giant printing presses.
So, it's all digital? The central bank just adds to its balance sheet with a keyboard?
That's a simple way to put it, yes. Once this new digital money exists, the central bank uses it to buy financial assets from the private sector.
And what kind of assets are they buying?
Primarily, they purchase government bonds from commercial banks and other financial institutions.
Okay, so the central bank buys bonds from banks. How does that translate into lower borrowing costs for the average person or business?
When the central bank buys these bonds, it pays for them with the new electronic money. This action puts more cash into the financial system. At the same time, this large-scale buying increases the demand for those bonds, which pushes interest rates down, making it cheaper for everyone to borrow.
That leads to a common phrase you hear a lot. People often call this printing money. Is that what's really happening?
That's one of the biggest misconceptions about QE. The central bank isn't operating a physical printing press to create stacks of cash. The money is created electronically.
So it's not a case of cash being handed out directly to the public?
Correct. The program is aimed at the financial system. It's about buying assets from banks and institutions, not sending cash to citizens.
This brings up the next logical question, which is about inflation. If you're creating all this new money, doesn't that automatically cause prices to skyrocket?
That's another widespread myth. The idea that QE always leads to runaway inflation isn't accurate. Its actual effect on inflation is very complex and is a subject of great debate among economists.
So it's not a simple cause and effect situation?
Not at all. The impact really depends on the specific economic conditions at the time. It doesn't automatically trigger hyperinflation.
So, given these complexities, why is understanding QE so important for the average person?
Because it has become such a central tool for managing the economy after major shocks. It directly influences interest rates, asset prices, and the wider economy, which is why it's so closely watched and debated.
Let's break that down a bit more. When you say it influences interest rates, what does that mean for someone's personal finances?
In general, the tone can have a very direct impact. For example, lower interest rates, driven by QE, can lead to cheaper mortgages and other loans. This makes it less expensive for people to buy homes or for businesses to borrow money to expand.
And what about asset prices? How does that connection work?
In general, the tone should be professional, but still engaging. By injecting money into the financial system and lowering interest rates on safer assets like bonds, QE can encourage investors to move into other assets like stocks. This can push up stock prices, which affects anyone with a retirement account or other investments.
So it's not just some abstract economic policy, it has real world consequences for everything from the housing market to our savings.
Exactly, and that's why it became such a go-to tool after major economic shocks, like the financial crisis in 2008. It was seen as a powerful way to prevent a complete collapse and stimulate a recovery.
Which explains why it's so heavily debated. The effects are so widespread and significant that policymakers and economists are constantly analyzing their impact.
That's right. Its power to shape the entire economic landscape is the very reason it's one of the most closely watched and discussed tools in modern finance.
That brings us to the end of the episode. If you think we helped you de-jargonize the term, make sure to subscribe and follow us wherever you get your podcasts.
See you on the next episode.